The FT has recently reported pretty high levels of cash in UK PLCs. Some of you advisors may well be aware that that's also the case with some of your private company clients. Now, as well as that piece of news related to corporate cash, I recently read an ICAEW, the Institute of Chartered Accountants of England and Wales, guidance note on cash inside companies. Now, they've taken a couple of points up with HMRC. The first one was around the business property relief capability, where a partnership holds shares in a trading company. That's not the point I want to look at. It's the second point I want to look at in this recording, and that's about the holding of cash inside private companies. Now, in volatile times, you can understand that many companies might want to hold a bit more cash just in case things took a turn for the worse, so to speak, in the future, and they couldn't get the money they needed from the bank. Holding high amounts of cash inside a company can detrimentally affect your business property relief. Now, provided you are substantially a trading company, you kind of qualify in principle for business property relief, the relief that relieves the value of your holding in that company to the extent of 100% from inheritance tax. However, if you hold, and to the extent that you hold, excluded property in that company, then you will not qualify for business property relief in proportion to that excluded property related to the overall value of the assets in the company. So if you're holding high amounts of cash and you can't attribute a specific business purpose, a business reason for holding that cash, then you will deny yourself some business property relief. For example, if the company were worth, its net value were worth, say, £1 million, and you held £200,000 of cash with no attributed business purpose to it, you're going to lose business property relief on 20% of the value of that company, very broadly speaking. So the ICAEW went to the Inland Revenue and said, look, in these volatile times, can't you make a relaxation, and can we just allow companies to hold a bit more cash with no attributed purpose? Because the purpose is kind of just, they're a bit worried about the future. Long story short, HMRC said no. So the fact you have to bear in mind when advising the owners of private company shares, often owner managers, on their inheritance tax position, is that they may not qualify as to 100% for business property relief if they're holding high amounts of cash. Now, that may lead you to another discussion with those kinds of company owners, and that is, what could we do with that cash? Can we get a better return on it? Because often it's just going to be sitting in the bank earning pretty much nothing. So if they're prepared to take a little more risk, you might be talking to them about investment. Now, at that point, you need to be asking a few more questions. First, of course, you need to ask, do you really need that money for running the business, in which case you oughtn't to be investing it. But we're starting from a principle that you wouldn't be having the conversation unless they didn't need that money for the business, because if they did, they wouldn't be having the discussion about inheritance tax. So, do they want to invest the money? Okay, you don't need to pay down debt, you don't need it for working capital. The next question will be, what do you want to invest in, and how much risk are you prepared to take? And if they're prepared to take a little more risk, and inevitably, if you're going to receive a better return, you've got to accept that you're going to take a little more risk. So, for example, if you wanted to invest in the equity markets because you perceive some more growth in there than just leaving it on deposit, then by all means consider it. And looking at collective investments, it may make, from a tax standpoint, quite an appealing investment, and a very simple one from a company standpoint. With the right portfolio, with the right acceptance of risk levels, you could look at an investment that produces dividend income that's reinvested, and we all know about the power of reinvested income, with no further tax on the dividend income, because dividends from UK companies to UK companies suffer no further tax. Not only that, capital gains tax, well, it isn't relevant to companies. They pay corporation tax on their capital gains, but only when they realise the gains, and then, unlike individuals, the company will qualify for indexation relief, which means that only the capital gains in excess of inflation, and that's inflation measured by the RPI, which is a bigger number than the CPI, will suffer corporation tax on the capital gains. So equity investment could look quite tax appealing if they're prepared for the levels of risk that you will recommend for them. However, before taking the plunge, you also need to have the discussion about the potential impact that investing that money might have on entrepreneurs' relief. Now, entrepreneurs' relief, simply put, is the very powerful relief from capital gains tax an individual business owner will get when they sell their business. It's a qualifying business, and let's assume most private trading companies will be. Then the owner, when they sell the business and realise the gain, will only suffer 10% tax on that gain up to £10 million. That's the benefit of Entrepreneurs Relief, a 10% tax rate as opposed to a 28% tax rate. Now you will run a risk of denying yourself Entrepreneurs Relief if you take that cash off deposit, cash that's been generated from trading, benignly sitting on deposit, therefore not in HMRC's eye invested, and place it in investment to get a better return, so with all good intent. If you then become other than substantially trading by virtue of that investment, and they'll look at the situation in the round, but broadly it's worth bearing in mind there's a kind of 20% test here. So if you're going to be at risk if you're investing more than 20% of the company's assets. So if you look at the asset value of the company, taking account of goodwill, and look at how much of that value that the cash you're investing represents. If that exceeds over 20%, warning bells ought to start ringing, because you really wouldn't want to be denying Entrepreneurs Relief to your business clients. So by all means have the discussion around corporate cash, it's a very interesting one to have, but please also bear in mind the impact that cash or investment has on business property relief when planning for inheritance tax, and also the detrimental impact that investing can have on future Entrepreneurs Relief.